In January 2026, a meeting happened that almost nobody reported on. Behind closed doors, the People's Bank of China quietly gathered the heads of China's biggest state banks. The topic? Getting rid of US Treasuries. Fast. Now you might think that's a China problem, a geopolitics problem, something that happens in boardrooms you'll never enter. You'd be wrong. This decision is already moving the price of everything in your wallet. Gold just crossed $5,000 an ounce. The dollar is wobbling. And the bond market, the bedrock of global finance, is under pressure it hasn't felt in decades. This isn't background noise. This is a system stress test. In real time. Stay with me. Because in the next 8 minutes you're gonna understand something Wall Street analysts are paid millions to track. And most people on the street have no idea is happening. Let's start at the foundation. When the US government needs money to fund wars, stimulus checks, infrastructure, it borrows. It issues bonds called US Treasuries. And for decades, China has been one of the biggest buyers. At its peak, China held over $1.3 trillion in US Treasuries. Today, that number has been cut nearly in half. And in early 2026, Chinese state banks received direct instructions to scale back further, urgently and quietly. Why did China buy so many in the first place? Simple. China exports massive amounts of goods to America. Americans pay in dollars. China ends up with a mountain of dollars. And for years, parking that cash in US Treasuries was the safest, most liquid option available. The US was the world's safe deposit box. But something has shifted. The trust that underpinned that relationship, it's fracturing. And when the second largest economy on earth decides the world's reserve currency is no longer the safe bet, the ripple effects are global. And they're already here. Back to that meeting in early 2026. According to sources close to the matter, the People's Bank of China didn't just suggest reducing treasury exposure. It urged state-controlled banks to treat it as a strategic priority, a directive, not a suggestion. The context matters here. 2026 has been defined by renewed US-China trade friction, new tariffs, new restrictions on semiconductor exports, new pressure on Chinese tech firms. Beijing has concluded it cannot afford to be financially held hostage. So it's pulling the trigger. Here's where it gets personal. When China dumps treasuries, supply surges, prices fall, yields, the interest rate the US pays go up. And when US yields go up, mortgage rates go up, car loans go up, credit card debt gets heavier, the cost of the American dream gets more expensive, quietly, automatically. Now look at what's happened to gold. It's crossed $5,000 an ounce. That is not a coincidence. Central banks, including China, have been loading up on physical gold at a pace not seen since the 1960s. Gold doesn't pay interest. You know why you buy it? When you don't trust the thing that does. Look at this chart. As China's treasury holdings have declined over the past 3 years, gold has done almost exactly the opposite. This isn't noise. It's a deliberate portfolio shift out of dollar-denominated debt into a hard asset no government controls. China is building a financial fortress. And here's the thing about gold at $5,000, it signals something the Fed cannot easily fix. It signals that smart, patient, sovereign money has doubts about the long-term purchasing power of the US dollar. The question is, should you? Quick pause. Real question for you. Do you still think the US dollar is a safe haven? Comment yes if you believe it holds its power. Comment NO if you think we're watching the beginning of a slow unwind. I read every single one. Now let's go deeper. The word panic gets thrown around too easily on financial YouTube. So let me be specific about what's happening on Wall Street right now. Treasury market liquidity, how easily bonds trade hands, has become erratic. Bid-ask spreads are wider than they should be. Volatility is up. The plumbing is making noise. Here's what keeps bond traders up at night. The US Treasury market is the world's largest, most liquid financial market. It's the foundation everything else is priced off of. When that market gets choppy, nothing is safe. Stocks, real estate, emerging markets, they all take cues from the Treasury yield curve. And right now the Federal Reserve faces a brutal dilemma. If it raises rates to defend the dollar and attract buyers back into treasuries, it risks crushing an already fragile economy. If it doesn't, if foreign demand keeps falling, yields could spike anyway. It's a trap, and Beijing knows it. This is the geopolitical weapon hiding in plain sight. China doesn't need missiles to put pressure on Washington. It just needs to keep selling slowly, steadily, and let bond markets do the work. It's financial warfare, bloodless, deniable, devastatingly effective. The obvious question is, if China stops buying, who steps in? Japan is still the largest foreign holder, but Japan has its own debt crisis to manage. The UK, Belgium, the Gulf states, they buy, but not enough to replace Beijing's scale demand. Not even close. The uncomfortable truth? The Federal Reserve may have to become the buyer of last resort. Again, that means printing money. Which means more inflation pressure. Which means your groceries, your rent, your savings, they all face a quiet, invisible tax. The debasement tax. Every major dollar printing episode in history has ended the same way. Assets surge, savings erode, and the people who held hard assets, gold, real estate, quality equities, they came out ahead. The people who sat in cash, they got quietly wiped out. So what do you actually do with this information? First, understand what's happening is not a crisis yet. It's a slow structural shift. You have time to be deliberate. Panic is never the move, but complacency is equally dangerous. The portfolios that survive dollar debasement cycles are not built overnight. They're built by understanding the macro trend early and tilting, not panicking. A small allocation to gold, exposure to assets that produce real cash flows, reducing pure cash drag. These aren't exotic strategies. They're what sovereign wealth funds have been doing for 3 years. The information asymmetry here is enormous. Most people won't hear about the PBOC directive until it's already old news. Most people won't connect gold at $5,000 to the bond market to their own mortgage rate. You just did. That's the edge. The dollar has survived crises before. The 1971 Nixon shock, the 2008 meltdown, the 2020 pandemic print. It may well survive this too. But the margin of safety is thinner. The number of countries actively building alternatives, BRICS settlements, gold reserves, bilateral trade deals, has never been higher. The meeting at the People's Bank of China wasn't a declaration of war. It was something quieter, and in some ways more significant. It was a vote of no confidence. And votes like that have consequences that compound over years. Just like interest. If you found this useful, subscribe. Our next video breaks down exactly how BRICS nations are building a dollar alternative, and which assets are positioned to benefit. You don't want to miss that one.